Great. Okay. Hello, everyone, and welcome. I'm Janice, and I'm the director of the Low Income Taxpayer Clinic here at Maryland Volunteer Lawyer Service. And I want to welcome everyone to this informative webinar today. I will introduce Ryan to you in just a moment, but before then, I do want to encourage everyone to follow MBLS on social media. Lots of exciting things happening, including trainings like this one. Ryan, if you'll move to the next slide, please. This is a great opportunity to put the information that you're learning in these webinars to use by taking a pro bono case as an MBLS volunteer. We do put all of our cases on the pro bono portal. So for anyone who is awake in the middle of the night and looking for a pro bono case, you can certainly go there. And this is where you'll find it. Next slide, please. MBLS is has been approaching all of its cases through a race equity lens. Recently, this is a very challenging time for everybody, and it has made us all think about things. We do want to remind everyone that the tax code does appear neutral on its face, but certainly it does not impact everyone in the same way. We also want to remind everyone that sometimes there are institutional systems which have perpetuated some inequities and create some additional obstacles or hurdles that our clients are facing these days. Next slide, please. Great. As a volunteer, we do encourage you to use your active listening skills, value the client's experience, and also trying to be non-judgmental. Trying to also understand that past experience of communities of color have with the tax system may be different than other people's experiences, and we encourage that you give additional space for clients to ask questions. Next slide, please. So again, we encourage you all, invite you all to join us as volunteers. For those of you who are students and listening, once you're barred, we welcome you to continue your great tax work by becoming a volunteer here at the MBLS LITC. This is an example of the MBLS Pro Bono portal where we list all of our cases. They are listed according to case category, and the little blue box is tax, which is a small box, but the most important box, of course, at MBLS. So next slide, please. Great. Okay. As a volunteer, we do invite you to all of our trainings as well as our recordings, such as this one. And we do have recordings of past trainings available on all of these categories, and that's on our website. So you're welcome to join in and listen to those without any charge. So next slide, please. Okay, if you are not yet an MBLS volunteer and you are a barred attorney, CPA, or enrolled agent, we do invite you to join us. So next slide, please. And with that, I am going to shortly turn it over to Ryan. If you have any questions, please feel free to go ahead and put them in the Q&A box. We'll be monitoring them as we go along. We may not answer them right away, so as not to disrupt the flow of the presentation, but certainly we do welcome a conversation regarding your questions. So Ryan, over to you now.
Okay, thank you very much. My name is Ryan McKay. I am a fourth-year evening student at the University of Baltimore School of Law and a member of the Low Income Tax Clinic. And today, the presentation is on the Earned Income Tax Credit. Just a little brief overview of the presentation. We're going to discuss what the Earned Income Tax Credit is, who it benefits, qualifications to apply for the credit, what is earned income, what is not earned income, some Social Security number issues that can arise, the Earned Income Tax Credit and immigration, and what it means if you have a client or a taxpayer who is an immigrant and wants to apply for the credit, revising returns for inclusion of adding the Earned Income Tax Credit to a return, some common filing errors, either intentional or not, and what can be done about them, and then what happens with the claim if it is denied, or what can be done if the IRS bans the taxpayer from applying for the credit for either 2 or 10 years. So the Earned Income Tax Credit is a refundable credit for workers who meet certain requirements and file a tax return. Listed here are the qualifications. Since it is the Earned Income Tax Credit, there must be earned income. of at least $1 and up to limits depending on your filing status as either single or head of household or married filing jointly. And those limits increase as qualifying children are added to that taxpayer's return. And even adding one child, you can see a significant increase in the income limit. For instance, under the single category, from just under $16,000 to just under $42,000. Now the credit itself is going to increase as the income increases up to a point where it'll plateau. And then as the taxpayer's income reaches this maximum, it is going to start phasing out and decrease. Another requirement for the credit is the taxpayer must have investment income below $10,000. This is a new limit in 2021. Previously, in 2020 and previous years, the limit was $3,650. So this increase will mean more people will qualify for the credit. In order to receive the credit, the taxpayer must have a valid Social Security number by the date the tax return is due. The filing status must be single, head of household, or married filing jointly. And the taxpayer requesting the credit must be a U.S. citizen or resident alien for the entire year. Additionally, the taxpayer must have either a qualifying child or children or meet the age requirement of 25 to 65 years of age and also not be claimable as a dependent on another taxpayer's return. And just to note, money returned as an earned income tax credit is not counted as income for the subsequent tax year. Here is what the maximum credit depends on the number of children being claimed. These numbers were pulled from the draft 1040 published by the IRS in September. And so the amount of the maximum is the same regardless of filing status, but the income level required to hit this maximum and where that falls is dependent on filing status, and that whole chart is listed in the 1040 for the taxpayer to figure out what the return is or the credit is. And just note that the credit is not going to be distributed before February 15th of the subsequent year for the tax year that it is being claimed. For qualifying children, there are 4 general requirements, and then I've added one additional requirement on there. So the requirements are relationship, age limit, residency, joint return, and the fact that a child can only be claimed once. So relationship, the qualifying child either needs to be your son, daughter, etc., or their descendant, but it also could be your brother, sister, half-brother, or their descendants. For the age limit for a qualifying child, they must be either 19 years or younger, and if they also must be younger than the taxpayer and their spouse if they're filing jointly. That age limit increases 5 more years to 24 if the child is considered a student. Now, to qualify as a student, child must be during some part of the year, at least 5 calendar months, a full-time student at a school that has regular teaching staff, regular course of study, regular student body. But note that the 5 calendar months do not need to be consecutive. And this age cap does get removed if at some point during the year, the child becomes totally disabled. For the residency requirements, the qualifying child must reside with the claiming taxpayer for at least half the year. And the joint return requirement, in order to be a qualifying child, that child cannot file a joint return with their spouse and be claimable as a qualifying child. There is an exception to this rule. if the qualifying child and their spouse is filing a joint return only to claim a refund of income tax that was withheld or prepaid, estimated tax that was prepaid, then that restriction will not be in place and they will qualify. And so this last one, the one claim per child, this can happen with separated parents or if there are multiple adults living in the same household. Essentially, the child can only be claimed once in any given tax year by a single taxpayer. So earned income, what is earned income? It is the taxpayer's wages, salaries, tips, strike and sick pay, union strike benefits, some disability benefits, for instance, disability retirement benefits. If the taxpayer is receiving disability retirement benefits before they reach the minimum retirement age, that must be claimed as earned income and will qualify for the earned income tax. If the taxpayer is receiving disability insurance payments and they did not, let's say their employer was paying for the insurance policy, that is considered income and will count. Now, if they paid for the premiums themselves, then that won't count. Social Security disability insurance doesn't count. SSI, supplemental security income, and military disability pensions also do not count as earned income. And with COVID and the economic impacts, the IRS has implemented a rule that for tax years 2020 and 2021, if the taxpayer earned income is less than what they earned in 2019, they're going to be able to elect to use that 2019 earned income when calculating their credit. And in doing so, the taxpayer, when filling out the schedule, needs to just enter PYEI, which stands for previous year earned income, and then that dollar amount. Not earned income. So these list here, this will not be included in the earned income for consideration of credit. That's interest and dividends, which is included in the investment income limit of $10,000. And then, and you can read here the whole list. Nothing listed here will be considered earned income for the taxpayer. Moving on to, so the investment income limit of $10,000, this is going to include the interest and dividends, any capital gain, net income, royalty income, net income from rentals of personal property. For instance, if taxpayer is renting out their house as an Airbnb, it's not a business, that income would be included here. Passive activities from Schedule E are also included here. And if the taxpayer is including their child's interest in dividends from a Form 8814, which is the parent's election to report the child's interest in dividends, that will count towards this limit. For self-employed taxpayers, the critical thing here is that anybody who is reporting self-employment income needs to report all income and deduct all expenses for the EITC. And this makes sense with regulations because self-employed taxpayers need to claim all allowable deductions when they're computing their net earnings for self-employment tax purposes. Something to watch out for if a taxpayer is earning self-employment income and that income, the net earnings is less than $400, that need not appear and might not appear on their Schedule SE. So it is possible that there's missing earned income on their return that could be considered for the credit or could potentially push them above the income limit if it was close. Income while incarcerated. So any income a taxpayer receives for services rendered while they're an inmate does not count towards the earned income tax credit. This includes any work done while on work release or while staying in a halfway house. That being said, any income that the taxpayer would have earned prior to or after release will count. So let's say the taxpayer worked in January and February, became incarcerated in March, and remained so for the rest of the year. The income they earned in January and February will count towards the earned income tax credit, and they will be able to file for it. Now, if a taxpayer does file for the earned income tax credit and they were incarcerated for the entire year, that will be disallowed. And if the IRS reviews their application and notices that it was based on incarceration income, this will trigger an automatic review of the previous tax years, whether or not the credit was allowed. And if it's determined that the previous credit was based on penal institution income, then they can revoke that grant, and the taxpayer will owe that back to the IRS. Social Security number issues. So the big thing here is right at the top, the Social Security number must be valid for the taxpayer at the time of filing their taxes. This will be a common theme through some of the remainder of these slides, but this is one of the first things to look at. If the earned income tax credit is claimed and denied, and all the other criteria are met, look for the Social Security. If the name and Social Security number of the taxpayer are valid and correct, then it should be granted. But if there is an issue with the Social Security number or name, then the IRS will not grant the EITC. And it's possible to have a qualifying child without a Social Security number in one instance, and that is if there is a birth and death of a child in the same tax year, and it occurred in such a way where no Social Security number was actually issued, then the Social Security number won't be required. They will also qualify as or treated as having lived with the taxpayer for more than half the year in this case. For adoptions, again, no Social Security number, no EITC. The adoption taxpayer identification number won't be allowed. Individual taxpayer identification number won't be allowed. And this is, this Social Security number requirement is strong, and the IRS does not allow for religious or conscience-based objections to having a Social Security number. For instance, Amish and Mennonites, so they won't have a Social Security number, and if they don't, then they won't be able to qualify for the earned income tax credit. Immigration. So one of the requirements is that you are either a U.S. citizen residing in the U.S. or a resident alien for the entire year. So immigrants will count for this as long as they meet all of the other requirements. Now, if there is somebody who is going through the immigration process and they haven't received Social Security number yet, but they're anticipating it, it would be advisable for them to wait to file their tax return until the Social Security number is obtained. And as long as that is obtained prior to the due date of the tax return, they can qualify for the earned income tax credit. Now, there are approximately 2.6 million illegal immigrants who have valid Social Security numbers. The first here, asylum applicants are people living in the United States illegally who have applied for asylum. Typically 180 days after applying for asylum, regardless of the underlying merits of their application, they may apply for work authorization and an accompanying Social Security number. These aren't necessarily individuals who have been granted asylum by a judge. And in fact, a majority of them will either abandon their claim or found to not qualify. The Deferred Action for Childhood Arrivals, or DACA program policy. It's an immigration policy that allows some individuals who have a technically unlawful presence in the United States because they were brought here as children, and they can receive renewable 2-year periods of deferred action from deportation. And as a part of the program, they can become eligible for a work permit. The Social Security Administration has an agreement with the Department of Homeland Security to assist the DACA, the people who qualify under DACA for work authorization and obtain the necessary Social Security number. Additionally, there's the temporary protected status, which can occur when the Department of Homeland Security designates a foreign country for temporary protected status due to conditions in that country that temporarily prevent the country's nationals from returning safely, or sometimes if the country is unable to handle the return of their nationals. DHS, the Department of Homeland Security, has given special authorization for those that qualify here to work in the US and receive a Social Security number. That's why stolen identities included here. There's 50 plus other ways for immigrants to receive a Social Security number. It's a little outside maybe the scope of this presentation. Just know that they're there and that it's possible to have a valid Social Security number for the EITC purposes. And even though these taxpayers might not be eligible for the EITC without a Social Security number, they can be eligible for the child tax credit if they have a dependent with a Social Security number, and the taxpayer has an individual taxpayer identification number, which is much more simple to receive for the. So what happens if a taxpayer technically qualifies for the EITC, but they don't apply for it? So what's supposed to happen is the IRS is supposed to notice this and issue a notice to the taxpayer that would qualify. Whether this happens or how frequently this happens, I'm not entirely sure. But what's supposed to happen is they'll issue either a CP09 or CP27, depending on qualifying children, and include with that form 15111 or 15112. The taxpayer needs to complete those forms and return them to the IRS, and the IRS will review that, and they have an 8-week window to review the worksheet. So if a taxpayer were to come to you and ask, saying, look, I received this notice, I filled out the form, I submitted it to the IRS, I still don't have my credit. If it hasn't been 8 weeks, advise them, wait for the 8-week period to lapse, and hopefully the credit will be issued. If it's been greater than 8 weeks and you contact the IRS and they have no record of the taxpayer's response, the best advice would be for the taxpayer to complete a form 1040X and attach the schedule EIC, which is the schedule that should have been completed if they qualified. If it had been greater than 8 weeks, contact the IRS and they say, we've received the response, but there's still no credit yet. Advising to complete form 4442, inquiry referral, and the IRS will have 30 days to respond to the status of the credit. Amending a return. So here this is contemplating just adding children onto a return after it's been filed. Again, Social Security number needs to be obtained by that child before the final due date of the tax year, or that claim will be denied. The taxpayer will need to fill out a form 1040X to amend their return, and include a Schedule EIC with the information showing that the child is a qualifying child. So what happens if the EITC is erroneously allowed? IRS makes a mistake. The common reasons for revising, reducing, or eliminating the credit. The first three there are Social Security number issues. Either the taxpayer, spouse, qualifying child doesn't have a valid Social Security number. If the taxpayer failed to pay self-employment tax, if the taxpayer failed to calculate their AGI correctly, or consider their investment income, or meet the age requirements if there is no qualifying child, or the child doesn't meet the age requirements according to the taxpayer's spouse or the taxpayer themselves. The IRS will issue a letter 3050C or a math error, which should explain the error. And the taxpayer can respond to that math error or submit an amended claim, amended return to claim the requested earned income tax credit. So here are some common errors that are maybe a little more intentional and will be disallowed. Claiming a child who is not actually your qualifying child. And this will occur if the taxpayer tries to claim a child who doesn't meet the 4 tests for a qualifying child: relationship, age, residency, and filing status. On the next slide, I'll discuss duplicate claims of a child on 2 different taxpayers' returns. So married taxpayers who incorrectly file as single or head of household, if the married couple filing jointly, their income would put them above the limit, but individually might not. They might try to claim single or head of household status, qualify for the EITC, and that will be disallowed. Also, income reporting errors, either over-reporting or under-reporting to either qualify for the EITC or maximize the amount of return. Again, that will be disallowed and could come with a ban for 2 to 10 years, depending. And that will be discussed in a little bit as well. So common errors that are correctable. So there are claim errors. And this is where a child is claimed by 2 separate taxpayers. Initially, the first tax return claiming the qualifying child or children will be allowed because at this point, there's no duplication. However, if the same children are claimed, then both tax returns will undergo an automatic screening process. And while screening, the IRS will use historical information and any information from external sources that's been made available to them to decide whether to allow the child or children or one or the other or neither of the taxpayers. And if the return is rejected for a claim error, the advice is to resubmit with the full information to show that the child qualifies. If there is a Social Security number mismatch, if either the taxpayer, taxpayer's spouse, or child listed on the Schedule EIC has a missing Social Security number, or the name and the Social Security number do not match the records from the Social Security Administration, the IRS may reject the return or send a math error notice. And so if the return is rejected or a math error notice is received, review the return, check the Social Security number. If it was incorrectly entered, the taxpayer can submit a corrected return or respond to the math error notice with the correct information. If upon review, the Social Security number is correct, then the advice would be to contact the Social Security Administration to try and correct any Social Security number and name mismatches. And then once that's been corrected, either send a new return or respond to the math error notice. Math error after a prior year's disallowance of the credit. So if the IRS denied a taxpayer's earned income tax credit in the prior year, or previous year, the client must show eligibility for the credit next time they claim it on their return. To do so, they must attach a form 8862, or information to claim certain credits after disallowance. The IRS might also ask for additional information based on the circumstances. If the taxpayer does not attach 8862 to the return, the next time they try to claim EITC, the IRS will send them the math error notice automatically disallowing the credit. If the client or the taxpayer receives this notice, you can either respond to the math error notice with the form 8862, or, it's possible the taxpayer doesn't actually qualify for the credit. And if upon review, it's determined that they are not eligible, then no further action is required at that time. So the math error notice, the biggest thing to do here is if the taxpayer receives the notice, they must respond or should respond within 60 days requesting abatement. This response will cause the IRS to issue a statutory notice of deficiency to assess the tax. And this is going to allow the taxpayer to petition the tax court should it get to that level. Now, depending on the issue that gave rise to the math error notice, as well as how the taxpayer and practitioner are responding, is going to determine how the response is going to be worked by the service. If the taxpayer just requests abatement with no additional information, it's going to be treated as an unsubstantiated math error. And at that point, the claim won't be allowed without further action. If the taxpayer is requesting a recertification requirement, then the process, it'll be processed by a correspondence exam. And if it's a really complicated situation, it's possible that the examiner will send the review to the area office and the regional headquarters for their review. To note, the IRS has been issuing math error notices for the refund recovery credit. They've been issuing CP 11, 12, or 13 notices. Essentially, the IRS is making changes to the return. These notices failed to advise the taxpayers that they had 60 days to challenge the notice. More recently, the IRS has been issuing notice 6470 to these taxpayers, informing them of their 60-day right to challenge. But this is just something to maybe keep an eye out if somebody approaches you with a question regarding their refund recovery credit. So denial, again here, if it's denied, taxpayer is going to have to fill out a form 8862. Now, depending on the circumstances, 26 USC 32K allows the IRS to prohibit the taxpayer from claiming the earned income tax credit for a period of time if they determine the taxpayer intentionally or recklessly disregarded the rules, which is a 2-year ban, or they're fraudulently claiming the EITC, which comes with a 10-year ban. When that ban is imposed, the taxpayer is supposed to be notified that the ban is being imposed. The letter that is included with that is supposed to advise the taxpayer of the ban and what conduct they undertook that gave rise to the ban. Also, the ban must be reviewed and approved by management in order to be imposed. And this is important because of a study that was done in 2011 that showed the 2-year ban was improperly imposed approximately 40% of the time, was imposed without the required managerial approval 69% of the time, and was imposed without explanation almost 90% of the time. Those are huge numbers. Now, starting in 15, the IRM was updated and the issuance of the 2-year bans began to decline, but these are issues that should be considered when dealing with a taxpayer who is facing an EITC ban. Another issue is reckless. Reckless is not defined for the examiner anywhere. The examiners are given very general guidance as to what is considered reckless, such as if this is the first time the EITC has been disallowed, or if it's clear the taxpayer thinks they're eligible but simply doesn't understand the rules. The IRM does make it clear that the mere failure to respond to the examiner's inquiries doesn't indicate recklessness or fraud, but the ultimate decision to recommend a ban is with the examiners themselves. And so I've listed here criticisms of the ban, and this is looking back at that study that there's a lack of defined standards in evaluating whether the taxpayer's conduct was reckless, inadequate procedural protections to ensure the taxpayer understands why the ban is being imposed, and then a lack of clear and meaningful way for the taxpayer to challenge the ban in court. So a ban's imminent. The first and best option is to get with the examiner before the ban is implemented and argue, against the ban by corresponding with the examiner. Again, here, if the taxpayer receives a letter, must describe the taxpayer's conduct that gave rise to the ban so they can address it. If the ban is implemented and the taxpayer has additional information that was not considered by the examiner when implementing the ban, the taxpayer can ask for an audit reconsideration. If the taxpayer does fail to present any additional information to either substantiate their claim for the credit or fails to present any information to address why the examiner imposed the ban, then the audit reconsideration will be disallowed. Specifically, this is, they're going to need to address the conduct that was cited in the ban letter. To note, the taxpayer must address the ban in the year of where the ban originated. For instance, if the taxpayer received a 10-year ban in 2018 and they try to challenge the ban for tax year 2021, the IRS won't consider lifting the ban. The ban must be, argument against the ban must be addressed to the tax year where the ban originated. And so the examiner may allow or disallow the ban depending on circumstances. And if, while the examiner is considering evidence, testimony, documents, they need to be following the IRM and the rules. And if the tax practitioner, is monitoring and the examiner is not following the appropriate guidelines set out in the IRM, then the tax practitioner, the suggestion is to reach out to TAS for support in the taxpayer advocate service. So reversing the ban, if the examiner is going to reverse the ban, it's possible to reverse the ban and allow the earned income tax credit or disallow. So they'll allow it if the taxpayer provides sufficient information to overturn the ban and substantiate their allowance of the credit. If the taxpayer only provides enough information to reverse the ban, but not enough to qualify for the earned income tax credit, it's possible that the ban could be lifted, allowing them to apply in later years, but have their credit disallowed for the current year. Now, For the tax court, this is maybe a little outside the scope. I'm going to touch on it here. After the ban goes into effect, and either if there's no cause for audit reconsideration or the audit reconsideration was denied, then you can go to the tax court. But this is where that math error notice issue comes into play. So hopefully after the math error notice, the taxpayer would request for abatement within 60 days. Then the service will have to issue the notice of deficiency, and that will secure the usual 90-day period to petition the tax court. And at this point, considering all the issues with the 2-year ban that have been noticed, it's a good thing to consider FOIA, Freedom of Information Act request, to determine the reason behind the ban, if it wasn't fully explained in a letter or at all, and whether or not the ban was actually sent for management approval. And that is the end, and I am happy to address any questions.
Great. Wow. That was really comprehensive. Took a lot of notes here. I learned a lot. Thank you, Ryan. If anyone has any questions, please go ahead and put them in the Q&A box, and we can try to address them. I had a question about the ban itself. I've had clients who show up and they didn't realize that they were banned. And so I guess it's always a question of, do we just go ahead and fill out that form, the 8622, to allow them to, now that they're past their banned time, to allow them to come back? Is it worth going back and trying to figure out why they were banned to begin with? They didn't even know they were banned. How I guess maybe part of the question is always, how far back do you take it?
That's a good question. I think it's going to depend on the circumstances around that individual taxpayer. If the ban has already lapsed, then I guess the question would be, are they going to try to retroactively claim credit? Or, what is the goal of going back?
In your research, did you come across anything that where a previous ban would impact a future EITC claim after they submitted that form? So they're banned, and then they're past their ban period, right? And so then they file a return. At which point then they learn that they were banned, but then they are able to file that new form and then no longer be banned, and so then can collect going forward. I guess would there be, is there like a mark on their record saying that future EITC should always be scrutinized more carefully because they've previously been banned?
I do believe that there is a mark on their record with the IRS. I don't recall exactly the procedures there.
Yeah. Well, so I think it certainly seems like it would be helpful for the individual to understand their history, and to understand, and then certainly if it was not a correct ban, or, it sounds like in your research that with the ban, they're supposed to get notice, they're supposed to get an option to challenge that ahead of time. And if they never knew that it even existed, it's sort of questionable as to whose fault was that? Was it the IRS's fault in terms of not submitting or giving appropriate notice, or was it more the taxpayer? And sometimes it's hard in our clinic because the taxpayers are transient. So it's possible that they may not have received the notice, or maybe they had gone to a fraudulent tax return preparer, and so there's something else going on there. But so I often wonder, how far back do we go? Is it necessary to do that? Certainly for the taxpayer, it would be helpful for them to have an understanding of what happened. But and then that leads me to my next question about where you said that the ban has to be approved by management, and there seem to be some steps taken before the ban is actually finally implemented. Then And I think you mentioned that it's always best to try to challenge the ban pre-ban, as opposed to once the ban is there, then to challenge it afterwards. But do the taxpayers actually get notice that, is the notice that, well, we don't agree with this and that you claim this fraudulently and therefore you are going to be subject to a ban? Or do they actually say like, ban is coming, last chance to
So I guess the question, receive notice that a ban is being worked on?
Yeah, I guess how does the taxpayer know that this is serious? This is
Right.
a ban is coming. I've never met anyone pre-ban. I guess maybe I always meet them post-ban. So I'm curious to see going forward, is there a way to to know, oh, this is going to be a problem? Is it just stem from understanding that there's a question about the EITC, and that if it's determined that it was a fraudulent obtaining of the EITC, and it's not always a fraudulent, at least and the clients that I've seen, it tends to be clients who have applied for the EITC, but then don't have the substantiation for that, and then so does that mean if they don't have the substantiation to prove the EITC, even though they were actually eligible for it, then is that considered fraud in the eyes of the IRS and lead to a ban? Or
from what I read, that should not rise to the level of fraud or the 10-year ban.
okay.
And in what I read, it's not supposed to, merely not responding to the math error notice and not responding to the examiner with substantiation should not be considered reckless. However, one of the things the examiners are suggested to review is whether or not this is the first time the credit has been denied. Or if this has happened year after year, it's possible that the examiner could look at that and say, okay, this is now the level of recklessness, because there is the lack of defined, what is reckless for the examiner to review. It is discretionary. It's going to be up to that individual examiner.
Okay. So it sounds like it has to rise to a fairly high level before you actually get to the ban. It could be that the EITC is disallowed for that specific year, but maybe not to the level of recklessness. And I believe that Professor Denmeyer would like to also join in. Certainly asked to unmute. Go ahead, Professor Denmeyer. Feel free to unmute whenever you'd like. See if I can unmute you. There you are.
Hi, can you hear me?
Yes, thank you.
Oh, no, you're welcome. Yes, I wanted to respond to your question about the EITC ban. And right now, a lot of that is still up in the air because it's really a systemic issue on the part of the IRS. And so what I would argue is to consider an audit reconsideration. And as you said, since they didn't receive notice, say that they didn't have the opportunity to dispute that. I really don't know how far that would go. But ultimately, I think that if you can't move it through, then it would be an issue for TAS to maybe address. I know that TAS has received a lot of complaints about these. And something too that's a very significant issue is that there really isn't any type of guidance from the IRS with respect to the EITC as to what exactly rises to the level of reckless. And they seem to have, I think Ryan said this earlier, that they just seem to throw that on there on so many of them. And when they are challenged and do make it to task court, a lot of times, they're determined not to have been reckless. And but it's definitely a different standard than what you would see, for example, if you're looking from the accounting standpoint and, what they consider, reasonable positions for preparers to take. It seems like they're not quite, seems like they're much more likely to throw on that on a return than they would, I guess, apply a penalty to a regular preparer. I hope that answers some
Yeah.
of the question. I know it's not quite as black or white as you would like, but yeah, that really is, and I'm glad you brought that up. It is such a significant systemic issue that really, really needs to be addressed within the IRS.
Great. Thank you. Thank you. I think that is helpful. So we do have a couple of other questions that I'd like to get to before we finish here. So the first question is a question about the option of election to use the prior year earned income. So the question is, what if the AGI in 2020 is negative, but is significantly lower than 2019? So,
So if the taxpayer's AGI in 2020 is negative and or significantly lower than 2019, then the advice would be to use the 2019 income for calculation of the earned income tax credit. I think, does that answer the?
I think so. Yes. Yes. So remember that the EITC amount can vary depending on what your income level is also. So if you have a higher income level but still under the threshold for the EITC, you get a bigger EITC return. So, and the nice thing about that particular rule is that, and that this is only specific to this year, it's not every year, unfortunately, but it's just specifically this year where you are allowed to make that choice between 19 or 20. I think mostly because so many people were unemployed or had lower income in 2020 that they made that allowance. I don't know that it's necessarily going to go forward. So just be aware of that. If you're filing returns, to make sure that to see what the current rules are before you start choosing what year you want to use. So here's another question about what if a divorced couple has 6 children, but each claims he or she is the head of household and have 3 children. Are you allowed to split your children? And what is I guess it goes back to the rules for what is qualifying, what is a qualifying child for the EITC purposes? Is that?
Right. And I think in this instance, it's going to come to probably the residency requirement. Where did those children reside for at least half the year? And if the divorced couple is going to split the 3 kids, 3 with each throughout the year, then that shouldn't be an issue as long as the children qualify and each of the divorced parties qualifies for the credit.
Right. So I think it always comes down, I always feel like it comes down to substantiation. There's always a potential of being audited. So if you can substantiate it, and that's actually what is happening, then it's certainly worthwhile. Yes, Professor Denmeyer, please join in.
Yes, thank you. Yeah, that's a very interesting question, and it pops up frequently both on the state and the federal side, especially because a lot of times you'll find that these spouses may have agreements between each other, or there may even be a divorce decree, some type of order from a family law court that discusses, how the exemptions are to be claimed. And so Ryan is absolutely right that it goes to where the children resided the most. And unfortunately, or fortunately, I don't know, but either way, if you have an agreement, as far as that's concerned, the agreement does not dictate what the IRS will determine. They're going to go back to the Internal Revenue Code that looks back again at the residency. And this has been a significant issue for those who've maybe negotiated in the family law courts, the splitting of them. And the way to get around that is that the one spouse would have to go back to the district court, let the judge know that the other spouse has violated the order if they claimed the child, and then get an order from the court that then would require the person who claimed it in breach of the contract to file an amended return to allow it to go to the other spouse. And that's something that's very confusing for taxpayers because they say, hey, I've got this court degree, you know, that this is what the court says. But in the end, ultimately, the Internal Revenue Code is going to trump the family law court.
I think that's
No, I'm sorry. I thought that was kind of a tangent of you know, that splitting the 6 amongst 2 spouses.
Yes, yes, and I agree with you, Professor Dunmeyer. I have seen many clients who come in and with their divorce decrees and say, oh, well, I'm supposed to be able to claim this or whatever. And it's always a challenge to explain to them that this is not something that we can fix in tax world, and that this is not necessarily how the IRS views things. But yes, absolutely. I think that's an important thing to remember, especially for our students as they're talking to the clients that, you know, the clients feel very strongly sometimes about that, especially when they have their divorce decrees in their hands and people are misbehaving. And
yeah, and they don't want to believe you either.
Right.
Yeah.
Definitely. Well, very good. Any other questions, please go ahead and put them in. I think we've gotten some really good ones here. You know, this on the surface, I always feel like the EITC is very simple. You know, it seems like a fairly simple concept of getting this credit, but then as you delve into it and look at other things, and yes, it certainly can be very complicated. And so, yes, Professor Dunmeyer, did you have something to add?
I also want to give a shout out to that I think is a great resource is if you're looking at different issues such as the systemic issues, such as the EITC ban. You're probably familiar with it. There is a great website, Procedurally Taxing, and that website often deals with the different systemic issues. And I want to say that probably a year or so ago that Keith's blog probably posted something on that. So I definitely would add that to your library subscribe to that site.
Yeah, so everyone, thank you, Professor Dunmeyer, for putting that in, plug in. I just put that in the chat for everyone. It's a blog called Procedurally Taxing. And I know that all of you are very excited to read about tax blogs, but this one is actually pretty entertaining, even for non-tax people. It tracks a lot of different topics, you know, a wide range of topics, and you know, it tries to relate them to current events, you know, so it's a nice way to kind of see something that's happening oftentimes in the celebrity world, you know, and say, oh, wow, look at this. This is and this is what the tax consequences are. So, and it is very well written. Yeah, sometimes it's a little above my head, but in general, it's a very easy to read blog. So definitely a very good one. And you know, even if you're not an expert on this, you know, it can serve as sort of a general resource or a review, and can point you in the right direction. So very good. All right. Well, thank you, Ryan. This has been an excellent comprehensive review of the EITC. For those of you listening, thank you so much for joining us. And I know that Ryan had put his email on there. So for people who have other questions, you're certainly welcome to contact him. Ryan has generously agreed to allow us to post this this webinar on our website for future review and his slides. So and I think it's been an excellent review of everything. So thanks so much, Ryan, for joining us today. And thank you, Professor Dunmeyer, for joining in as well, even though we can't see you. Thanks, sir.
Oh, you're welcome.
Thanks so much. So great. And thanks everyone for joining us. Take care.